All right, so this is a picture of a problem in the back of the textbook. This is exercise 6.6. So I wanted to give you another illustration on the concept of closing entries. So you'll notice in this problem they've given you all the different accounts that this particular business is using. And again, we are interested in closing out the temporary accounts. So I'm just going to draw a line right there. Notice this, you've got cash, accounts receivable, supplies, prepaid insurance, equipment, accumulated depreciation, and accounts payable. Well, guys, those are all what we call permanent accounts because, again, they're on the balance sheet. So all these accounts will not be affected in the closing process. Everything else, the capital account, even though that's on the balance sheet, we are going to be updating this account. That's what we're going to be doing this closing process. We've got the drawing, there's fees income, and then everything else, notice you've got the word expense behind it. And again, I'm just going to kind of highlight these. These are all, again, these are your temporary accounts, with the exception of capital. Capital is a permanent account. It's the only permanent account that you use in the closing process. Because remember, essentially what we're doing is we're going to transfer all of our temporary accounts into this capital account to get a new balance. It's basically your equity statement balance. All right, so on the next slide, again, I have all the journal entries written out. It's in your solution, but just to kind of remind you, so we're going to do this in a 4-step process. We'll start first with just to remind you, we're going to close out the revenues first. Second, we're going to close out the expenses. And then thirdly, we're going to close out income summary. That's that new account that they're using just to help you close the temporary accounts. And then number 4, we're going to close out the drawing account. So those are going to be the 4 steps, the 4 different types of entries we're going to do in this chapter. And then note the balances. Capital has $65,000, drawing $6,500, fees income, which is your revenue, is $187,230, depreciation expense is $10,580, insurance expense $5,700, and so forth. Just remember, these are the amounts that are right now appearing in your ledger. So remember, think of, we're using the T account concept for our ledger. So for example, capital would right now have a credit balance of $65,000. And then once we go through all these 4 different closing entries, what's going to happen is everything's going to be transferred into capital, and then we're going to get a new balance, and then we're going to be done. So again, on the next slide, I'm going to again walk you through the entries, and then I'm going to show you the ledger aspect of this. All right, so here's your journal, and this includes all of the 4 different closing entries. Note, here's the first one. I'm just going to label this as number 1. Notice they're debiting fees income for the $187,230, and then they are crediting income summary for $187,230. So just to kind of illustrate this, so if we had our ledger pulled up and we had a T account set up for, let's say, income summary, write that out right there. After this first entry, you would post this to your ledger, and income summary would now have a balance, a credit balance of $187,230. Now, fees income, let me write this out over here just to illustrate. So using our T account idea, fees income, which is a revenue account right now, would have $187,230 in the ledger. By posting this entry, what's going to happen is when you debit fees income for $187,230, you are in effect closing it out, and it now has a 0 balance. So that's one of the objectives of closing entries, is to zero out your temporary account. So after this first entry, fees income would now have a 0 balance in the ledger, and this balance right here of $187,230 is temporarily transferred in income summary. Now remember, eventually we're going to get to the capital account. All right, now the second group is we're going to close out the expenses. Notice this is a compound entry. You've got depreciation expense, insurance, rent, salary, supplies, telephone, utilities. I'm going to circle all these. This is all of your expenses from the previous previous page. If you add all those up, your total expenses is $126,680. So here's your journal entry. You debit income summary, so we'll post that. So you got $126,680 680 posted, and then hopefully you can visualize all these expense accounts. I'll just kind of do one of them. So for example, if you've got depreciation expense, it would right now in your ledger have 10,580 as the balance. Once you post this closing entry, it would be posted as a credit to depreciation expense, 10,580, and then of course now that is at zero. That would be the same for all of these individual expense accounts. They would individually be posted, and then after you did that, they would all have a balance of zero, just like depreciation expense. So again, that's another objective of closing, is to close out your temporary accounts, so revenues and expenses. Now, if I go over to income summary, let's check this one out, again, your ledger. So remember, the credit part represents your revenues, and the debit part represents your expenses. So if we were to say calculate the balance of income summary, the balance would be 187,230 minus 126,680. That would give you $60,550. Notice that's on the credit side. So look at the third entry, label this one right down here. Notice on the third entry is we're going to debit income summary for $60,550. We're going to close this out, and then notice we're going to credit the capital account. So if I go down here and I say capital, and I believe if you go back to the previous page, I believe capital had a beginning balance, a starting balance of $65,000. I think that was the beginning balance, just so you know that. Now, when we do this third entry, we're going to transfer this $60,550. Notice it's going to be crediting capital. Write that right there, $60,550. That essentially represents net income, which should make sense to you because net income should increase capital. A credit to capital is an increase. That's what you want. Income summary gets posted as a debit of $60,550, and so after that part, income summary also has a zero balance. The fourth entry is to close out drawing. Notice you're going to debit capital for $6,500. I'm going to write that over as a post. And then, of course, the drawing account, if you had gone into your ledger, would have a debit balance of $6,500. Once you post this entry as a credit to the ledger of $6,500, drawing would also be at zero. Now, at this point, everything is in capital, the capital account. And at this point, you would just have to calculate the new balance of capital, and then that would be your updated balance, and that would be the balance that's going to show up on the income statement. And again, we'll show you this again on the next couple slides. All right, so this would be what your solution looks like. And again, I'm going to put this in the T account perspective. So if I write out capital, like I did again on the previous slide, notice the beginning balance would have been $65,000. That's the starting point. And then notice, I think I did this on the previous slide, the posting of the $60,550, that was from income summary. That represented net income. I'm just going to label that as net income. And then the debit of $6,500, that represented the drawing. And if you recall, drawing reduces capital, net income would increase it. So at that point, you would then calculate an ending balance for capital, and you'd get 119,050. That would be the balance that would show up on, guess what, on the balance sheet. All right, everything else, just to kind of show you again, there's in the 4-column format, what we would have done is we would have had, for example, in this one, drawing, we would have said, okay, drawing has a debit balance of $6,500. The closing entry would have been a credit, and of course, that would have given you a zero balance. Notice they're showing a zero balance for drawing. Okay, so here's the rest of them. Notice you've got fees income, and then here's your depreciation expense, insurance expense, and again, notice they're showing you all of these have a zero balance at this point. That's after closing. And again, just to illustrate again, if you're confused, fees income, if we had done this in the T account format, you would have started off with a $187,230 balance. That's your revenue. The debit of $187,230, which they're showing right there, would have looked like that. And then you would have shown a zero balance. Same thing with your expenses. I'll just do this first one. So again, if you had depreciation expense, here's our T account. So if you had $10,550 $10,580 as your balance. That's what they're showing right there. I'm going to circle this one. That's the closing part of it, the $10,580. Notice you would get a zero balance just like they're showing. So again, T accounts for the 4-column ledger doesn't really matter. It's just as long as you understand the concept of a ledger and what it's designed to do and what the closing entries, how they're affecting the ledger. Again, is your temporary accounts, revenues, expenses, and drawing, everything should have a zero balance after the closing. All right, and I believe this is the last one on there. You had insurance expense. Here's rent expense. Notice again, there's your zero balance. Everything should be zero.